One of the things that KKR is really notable for was during the pandemic, the most active fund buying up things left and right when basically everyone else was frozen. Here we are in the midst of another crisis. Is it the same?
Dani, it's great to see you and thank you for having me. It's true that COVID was a crisis that we prepared for. We didn't know what would happen, but we knew after a 10-year bull market something would happen. This crisis is different. We all knew inflation would rise. We all knew that interest rates would rise, but nobody obviously had this war on their radar screen. What I can tell you is it is similar in the sense that it's accelerating rapid change, especially here in Europe, that presents an incredible investment opportunity over time. But it's different in the sense that I can't tell you that this will be over within a predefined amount of time. We just don't know, and therefore we are battening down the hatches for sure in our portfolio, but also in our investment approach.
What is that conversation like with portfolio companies? Are you preparing them for a recession?
It is important to note that after the record stimulus, it is clear that central banks will have to continue hiking even if we have a stagnating economy. Therefore, when we prepare our portfolio companies, we certainly are having a conversation around cost control, around making sure that you really prepare for an outcome where you don't get back to, immediate stimulus.
Coming off the back of a really record period for private equity, last time we were at this conference at the end of last year, everyone was kind of cheering how good of a period it was. Do you think that cheer is going to remain considering how difficult of an environment you're describing?
Our job as an industry is to fundamentally change the companies we invest in. So now's the time. It is clear that now that the tide is coming back, we see who's swimming naked. There's going to be much more differentiation. It's not enough to just put capital in your companies. You have to fundamentally transform them, internationalize them, prepare them for this energy transition, digitize them. So as an industry, the ones who can do this, and as a firm, we very much focus on this.
What about valuations? Because part of that being left out to shore, seeing who's left naked, is part of that people who just overpaid for companies that in this current environment, it doesn't seem worth that price anymore.
It is clear that, we invested the bulk of, our latest fund during COVID. It is clear that valuations came to a level that was non-sustainable. Growth was priced at 2x what it was priced before the second half of last year. We will certainly continue to see an adjustment. If you look more broadly, the S&P 500 is still roughly 15% higher than we were in January 2020, so before the onset of COVID, and the DAX roughly 7-8%. So this has not gone through. Our investment approach is to partner and to fundamentally change the company so we are less exposed to the entry valuation.
So they might still be elevated from COVID, but this year obviously markets have fallen a lot. DAX I think has fallen, some 17%. Quickly here, but Philip, are you seeing take privates look more attractive with that fall in price in the public markets?
We have a period of adjustment now. The human psyche is you're not going from a bull market mentality to a bear market mentality within weeks. It'll take time for people to realize that this is not a blip. This is the new reality that we face over the next year, 2 or even longer.
Right.
And once we are through that, we definitely, in our view, will see more take privates and more of that type of opportunity, yes.